Coming to you straight from Manila, Philippines, this is Up With Esther. Today we are tackling the latest in the tech scene, tech funding in Southeast Asia. The latest in Southeast Asia tech funding is set for the worst this year since 2016, and investors' recovery to start in 2024 at the earliest. Venture capitalist firms in Southeast Asia are pickier this year, with valuations plunging and economic headwinds slowing growth since 2022. The era of easy money is already history, said Yinglan Tan, CEO and founding managing partner at Singapore-based Insignia Ventures Partners. And we've certainly felt it this year. So far, midway through 2023, up to July 11, total capital raise has only been $3.2 billion compared to $34.7 in 2021 and $18.3 in 2022. The number of funding rounds have only been close to 200 so far, while compared to 2021 it reached almost 1,000. The biggest thing to watch out this year is how companies are going to grow, defend their valuation, and survive the challenging environment, said Jeffrey Zhou, co-founder and managing partner at Indonesia-based Alpha JWC Ventures. According to data firm Crunchbase, venture capital-backed companies raised only $369 billion for the first quarters of 2022, a far cry from the whole of 2021 record-breaking feat of $679.4 globally, which was a 98% increase from the year before that. We have observed Southeast Asian VC deployment contract by 25 to 30% last year in 2022, relatively more so in Indonesia and at the Series B plus stage and less so at the seed and Series A stages, said Gavin Teo, general partner at Altara Ventures. Most funds have capital to deploy, but they are looking for great investment opportunities, said Shusi Salubara, co-founder and managing partner of Asia at Antler. In 2022, venture capital funds raised $151 billion in the first 3 quarters of that year, exceeding any prior full-year fundraising, according to data from private market data platform PitchBook. Sikea Southeast Asia raised an $850 million fund in June last year, while East Ventures raised $550 million in July of last year, and Insignia Ventures Partners raised $516 million in August last year. Tech stocks certainly took a tumble at the start of this year amid rising interest rates and disappointing earning results. Many tech companies, big and small, had to go through so much layoff rounds to be able to adjust accordingly. For the last 10 years, it has been FOMO investing, said Peng T. Ong, co-founder and managing partner at Monks Hill Ventures. He was referencing how big-name investors poured money into the collapsed crypto exchange FTX for fear of missing out. Southeast Asian tech companies have lost most of their valuation since going public. E-commerce giant and NYSE-listed C-Market's capitalization stands around $30 billion, down from more than $200 billion late last year. GoTo's 400 trillion rupiah or $28 billion valuation has dropped more than 75% since it went public in Jakarta in April last year, while Grab has lost 69% of its initial valuation of about $40 billion since its December 2021 debut. We are back to reality. People are starting to go, you need to have a path to profitability. You need to be default alive, said Ong, using a term to refer to companies that can turn a profit before they run out of money. You need to have positive contribution margins. These are the things that we should have been saying all along, but we were too caught up in the money cycle. Venture capital firms have been pushing their portfolio companies to extend their runways as uncertainty lies ahead. Investors are spending more of their deployable capital and time into supporting portfolio companies to shape up their capital efficiency, said Insignia's Tan. It's not that we didn't care about profitability last time, said Alpha JWC Ventures Joe, but almost no startup is profitable in the first 5 years. Maybe the shift in mindset is, let's be more prudent in growing. Yes, they can burn. No, they do not have to be profitable now, as long as they are capital efficient and have strong unit economics. This drier fundraising landscape is a litmus test revealing the true sustainability of business models and sector demands, said Insignias Tan. The companies that actually last this winter will prove to be survivors of the down market situation. So in a way, the market is doing a lot of work for the investors, said Jessica Ko, a director of investments at Vertex Ventures. Some sectors, such as quick commerce, have already seen casualties. Quick commerce promises to place orders in customers' hands in less than 30 minutes. Indonesian quick commerce firm Bananas announced last year in October that it was closing its e-grocery operations after failing to make the economics work. It first launched in January 2022, while Grab discontinued its quick commerce service GrabMart Kilat in Indonesia. Internationally, several companies, GoPuff, Gorillas, Jiffy, Getter, Zap, and Bike have announced closures, strategy pivots, or layoffs. The 15-minute model of quick commerce in Southeast Asia is very difficult because the unit economics are very negative. Basket sizes and order sizes are quite small, said Teo of Altara Ventures. With a flood of cash now swept away, it is becoming more clear which companies were not ready for the challenging environment, said Insignias Tan. And that's it for today. Thank you so much for sticking around. More episodes coming right up.